Imagine picking the perfect stock. Your portfolio soars. Now picture meeting the ideal partner, someone who lights up your world. Have you ever thought to yourself, I wish I'd invested sooner and met the right person earlier? What if I told you those two dreams, wealth and love, share the same foundation? Today, we're unlocking the secret to achieving both, because the principles that lead to smart investments can also guide you toward the right relationship. In this video, we'll explore the 3+1 strategy, a simple yet powerful framework for making better decisions in both investing and love. When you get both right, you don't just win, you thrive. Welcome to Value Runtime. I'm Young, a Wall Street veteran, Silicon Valley innovator, and Stanford-trained entrepreneur. Over the years, I've delivered value and created wealth across industries, from global technology companies to top financial institutions. Now, I'm channeling those insights into my own venture and sharing everything I've learned with you. In today's video, we're diving into a topic that touches both your wallet and your heart. I'll walk you through a trusted framework I call the 3+1 strategy, a unique method for making smart choices in both investing and your love life. We'll break it all down, step by step, so you can build a strong stock portfolio and cultivate meaningful and lasting relationships. Stick around because what you learn today will transform both your financial future and your personal happiness. Let's picture this. You finally discovered a stock with immense potential, a hidden gem that could set you on the road to financial freedom. This is the kind of win every investor dreams about. But here's the secret. It's not just about picking any company. It's about choosing one with strong and consistent profitability and the resilience to weather market ups and downs. Now let's imagine applying that same discerning eye to your love life. Instead of settling for someone who looks good on paper, but lacks the essentials for a lasting relationship, why not search for a partner who truly has what it takes to stand the test of time? After all, just as you wouldn't invest in a company without solid fundamentals, you wouldn't commit to a partner who can't handle life's ups and downs. It's all about finding that gem, someone who offers both stability and long-term promise. Over the years, I've developed a straightforward framework, the Core 3+1 method. At its heart, this approach combines three key quantitative indicators with one crucial qualitative factor. Not only does it give you a balanced view of a company's health and growth potential, but it also offers surprising insights into what really matters when choosing a life partner. Now let's break it down step by step. Let's kick things off with the first pillar of the 3+1 strategy, profitability, the heartbeat of any successful venture. In the world of stocks, profitability is the measure of how effectively a company turns its revenue into profit. We typically assess this using key ratios, such as gross margin, operating margin, and most importantly, net margin. The net margin tells you what percentage of a company's revenue remains after all expenses are paid. This ratio is crucial because it shows whether a company is generating real value from its operations. To illustrate, consider two local coffee shops. Imagine Young's Coffee sells a cup of coffee for $5, but after paying for rent, wages, and supplies, it only makes 5 cents in profit per cup. That's a net margin of just 1%. In contrast, picture Vera's Coffee charging $8 per cup and managing to keep $4 as profit. This results in a healthy 50% margin. Although customers might flock to Young's Coffee for the lower price, investors often prefer Vera's Coffee because its strong profit margin shows it can better handle rising costs, economic swings, and competition. Now let's translate this concept into the realm of relationships. Think of profitability in a relationship as the ongoing intangible value a person brings to your life. Their emotional support, shared interests, and the potential for mutual growth. Just as an investor is drawn to a company with a strong profit margin, you're naturally inclined toward a partner who consistently enriches your life. For instance, imagine two potential partners, one who is charming and fun for a while, but doesn't contribute to your growth, and another who offers consistent support, empathy, and shared goals. Over time, the latter, much like Vera's Coffee, proves to be the much more rewarding choice. Let's talk about the second pillar, financial health. For stocks, financial health is commonly measured by the current ratio, which is calculated by dividing a company's current assets by its current liabilities. This ratio is a straightforward indicator of whether a company can cover its short-term obligations. A ratio below 1 is a red flag, indicating potential liquidity issues, and a ratio of 1.5 or higher suggests that the company has a comfortable buffer to handle unexpected challenges. Now think about what financial health means in the context of a relationship. It's not just about the numbers in your bank account, it's a reflection of overall stability, responsibility, and the capacity to navigate life's unexpected challenges. When evaluating a potential partner, you want someone who exhibits consistent behavior, demonstrates emotional maturity, and has a stable lifestyle. I remember when I was younger, I once dated someone who had all the charm, but lacked the practical side of life. Small issues would snowball into major problems. That experience taught me the importance of stability. Just as you wouldn't invest in a company that might go bankrupt due to poor liquidity, you wouldn't want to build a future with someone who can't maintain stability in everyday life. The third piece of the 3+1 strategy is one that trips up even the smartest investors: valuation. You found a company that's profitable and financially stable, but is it worth the price? The price to earnings, or PE ratio, helps you understand how much you're paying for each dollar of a company's earnings. Essentially, it tells you the number of years it would take for the company's profits to pay back its current stock price. This metric is important because even if a company has solid fundamentals, overpaying for its shares can diminish future returns. For example, if a company has a low PE ratio, it might indicate that the stock is undervalued, a bargain compared to its earning potential. Conversely, a high PE ratio could signal that the market is overestimating the company's future growth, potentially leading to overvaluation and diminished returns if expectations are not met. Of course, this metric isn't perfect, especially in sectors like technology, where early-stage companies might even report negative earnings. In such cases, investors often look at other metrics, like gross margin or revenue growth, to get a clearer picture. Now, let's turn this concept toward relationships. In the dating world, valuation might mean assessing compatibility and long-term potential. Think of it as making sure you're not overpaying emotionally for a relationship that doesn't deliver the value you're looking for. Just as you'd scrutinize a stock's PE ratio to gauge whether it's a bargain, you should evaluate a potential partner's overall value. This includes their personality, life goals, and emotional intelligence. A partner who seems ideal on the surface might turn out to be less compatible in the long run if their values or aspirations don't align with yours. Let's consider the analogy of shopping for a luxury item. You want to make sure you're paying a fair price for the quality and benefits it offers. In relationships, it's essential to invest your time and emotions in someone whose price is right. That is, someone who matches your aspirations and brings genuine and lasting value to your life. If you're enjoying this video so far, please consider subscribing to Value Runtime and hitting the like button. Your support helps us reach more viewers and inspires us to keep delivering great content. Now we've covered the numbers: profitability, financial health, and valuation. But here's where it gets interesting: the +1. This is the thing that doesn't show up on a spreadsheet, but makes all the difference. In investing, we call it a moat. A moat is an intangible competitive advantage that protects a business from its rivals. It can take various forms: a strong brand, proprietary technology, a loyal customer base, or even a unique corporate culture that's hard to replicate. A robust moat means that even if competitors try to copy a company's products or services, they will find it exceedingly difficult to erode its market share. Let's dive deeper into this concept. Imagine a company like Apple. Beyond its impressive financial metrics, Apple's brand, its design ethos, customer loyalty, and ecosystem creates a moat that keeps competitors at bay. Consumers are willing to pay a premium for Apple products, not just for their functionality, but for the overall experience and status that comes with the brand. This is the kind of qualitative advantage that isn't captured by numbers alone, but is crucial for long-term success. When we apply the idea of a moat to relationships, we're talking about the unique qualities that make a person irreplaceable. Your partner's personal moat might include traits like empathy, a great sense of humor, deep integrity, or an ability to connect on a profound level. These are the qualities that can't be easily replicated or faked. They make someone stand out in a crowded field. It's the difference between someone who is superficially attractive and someone who offers a truly lasting and supportive partnership. I remember a friend who dated someone with all the flash and excitement, looks, charm, and big energy. But over time, it became clear that the person's moat was thin, lacking depth and consistency. In contrast, another friend found a partner who might not have been the most glamorous on paper, but had that unbeatable combination of loyalty, humor, and genuine care, a true personal moat. In both cases, the long-term value wasn't just in the obvious traits, but in those intangible qualities that created stability and trust over time. That's the power of the plus one. Whether you're investing or dating, it's the moat that separates something good from something exceptional. Numbers get you in the door, but the moat is what keeps you around. It's important to note that these indicators do not exist in a vacuum. In the world of investments, different industries have vastly different norms. For example, the average net profit margin in the banking or technology sectors can differ significantly from that in consumer goods or retail. When comparing companies, it's essential to benchmark their financial metrics against industry averages. This contextual analysis ensures that you are not misled by numbers that may look impressive in isolation, but fall short when viewed in a broader context. Likewise, the world of dating comes with its own set of dynamics and expectations. Different dating pools have unique characteristics. What one person values in a partner might be completely different from what another seeks. In a bustling urban environment, qualities like ambition and adaptability might be prioritized, but in a smaller community, reliability and long-term commitment might be more highly valued. It's critical to compare apples to apples, whether you are evaluating financial performance or personal compatibility. Use your analytical judgment and avoid relying solely on one metric or superficial impressions. All right, let's zoom out and tie it all together with some real-world examples. Take the well-known company Apple, for example. With a net profit margin around 25%, Apple not only demonstrates strong profitability, but also benefits from an unparalleled brand and ecosystem, a moat that is nearly impenetrable. This combination of robust financial metrics and strong qualitative factors makes Apple a favorite for long-term investors. Contrast that with companies in highly competitive sectors, where margins might be much slimmer. In such cases, the strength of a company's qualitative edge becomes even more critical. Now think about two local coffee shops, Young's Coffee and Vera's Coffee. Young's Coffee might operate on razor-thin margins, barely scraping by on low prices, but Vera's Coffee has built a reputation for quality, innovation, and a unique selling proposition. For an investor looking for long-term value, Vera's Coffee, with its higher margins and unique selling proposition, is far more appealing. Similarly, in the dating world, you might encounter someone who is charming but inconsistent versus someone who is steady, supportive, and aligned with your values. Much like Vera's Coffee, the latter offers true long-term value, even if they don't dazzle you at first glance. I've seen this play out time and again, whether in boardrooms or at dinner tables. Successful investments and enduring relationships both require a blend of quantitative metrics and qualitative charm. It's about knowing where to look, understanding the nuances, and making decisions based on a comprehensive picture rather than just surface-level impressions. So, what should you actually do with all of this when it comes to picking winning stocks and choosing the right partner? When evaluating investments, you should begin by focusing on the hard data. This means looking closely at profitability, financial health, and valuation. Metrics like net profit margin, current ratio, and the PE ratio serve as essential screening tools that help you filter out the noise. However, don't stop there. It is critical to delve into the qualitative aspects as well. Consider whether the company has a strong brand, benefits from a network effect, or holds any unique competitive advantage that sets it apart from its peers. Keep in mind that even a company with excellent fundamentals can become a mediocre investment if you overpay for its shares. Context matters, so always benchmark a company's performance against its industry peers and understand that temporary setbacks in emerging sectors might simply be part of a longer-term growth trajectory. Now, apply that same level of diligence to your love life. Just as you wouldn't invest in a company without thoroughly checking its fundamentals, don't rush into a relationship without evaluating the basics. Look at the hard data of a potential partner. Assess whether they are emotionally stable, financially responsible, and consistent in their behavior. Then turn your attention to the qualitative signals. Does this person have that unique spark, genuine empathy, or resilient character that sets them apart from others. A great relationship, much like a great investment, is built on a mix of measurable qualities and those intangible attributes that simply can't be quantified. The key is to find someone whose overall value is in balance with what they bring to your life. Someone who not only catches your eye, but also supports your long-term growth and happiness. By applying this balanced 3+1 strategy to both your portfolio and your personal relationships, you set yourself up for double wins. Whether you're making investment decisions or choosing a life partner, the same smart and informed approach will pave the way for lasting success in both your finances and your heart. So here's the big idea. Whether you're investing in a company or in a relationship, the 3+1 strategy helps you look beyond the noise and focus on what actually matters. Profitability tells you if it's truly adding value. Financial health shows whether it can weather life's storms. Valuation reminds you not to overpay emotionally or financially. And moat makes something or someone worth holding on to. At the end of the day, success isn't about short-term highs. Instead, it's about long-term decisions that compound over time in your portfolio and in your life. If you found this video helpful, go ahead and hit that subscribe button. Give it a like and share your thoughts in the comments below. Which part of the 3+1 strategy resonated most with you? Profitability, financial health, valuation, or the moat? And have you ever used a similar approach when picking a stock or choosing a partner? I'd love to hear your perspective. For deeper insights and helpful resources, check out ValueRuntime.com. I'm Jan at Value Runtime. Thanks for watching, and I'll see you in the next video.